Imagine the year 2022 when I watched $10,000 in crypto evaporate faster than ice on a Saigon sidewalk. Bitcoin crashed from 69,000 to 16,000, altcoins bled 90%, and every YouTube guru screamed HODL while I stared at a red screen, wondering if I'd just lit my savings on fire. That was the moment I swore I'd never again gamble on hype, and by December 2024, I turned that same 10 grand into $100,000. Not with moonshots, not with leverage, but with a boring sounding weapon called tokenization that regulators finally blessed in 2025. And today, I'm handing you the exact 4-layer crypto shield, plus the 4-step safety playbook that delivered a clean 10x return while the market still swing danced between fear and greed. So buckle up, because this isn't financial advice, it's financial confession, told in one unbroken breath the way I wish someone had told me before I learned the hard way. Layer 1 of the shield is Gaicham and Stablecoin Cash, the only crypto that doesn't pretend to be anything it isn't. USDC, fully backed 1-to-1 by dollars sitting in FDIC-insured accounts, audited monthly, living on Ethereum, Polygon, and Solana so I can move it globally in seconds for pennies. I keep 20% of the crypto slice here because it's the emergency fund that earns 5 to 6% APY on platforms like Coinbase or Aave without ever touching price volatility. And when I needed to pay a contractor in Dubai last March, I sent 5,000 USDC. He received it in 12 seconds. No Swift fees, no bank holidays, just pure frictionless money. And that single transfer saved me $400 in wire costs alone. Layer 2 is Bitcoin ETF Armor, because in January 2024, the SEC finally approved spot ETFs, BlackRock's IBIT, Fidelity's FBTC, and suddenly I could own actual Bitcoin inside my regular brokerage account. No seed phrases, no hardware wallets, no late night panic about exchange hacks. I allocate 30% of the crypto bucket to IBIT because it tracks BTC price perfectly, trades during Wall Street hours, and lets me harvest tax losses without ever selling the underlying asset. More on that in step 3. And when Bitcoin ran from 60,000 to 104,000 in the first quarter of 2025, my ETF slice alone grew from $3,000 to $5,200 while I slept through the volatility. Layer 3 is DeFi Yield farming on regulated rails. The part that still feels like stealing but now wears a seatbelt. I stake USDC on Compound or Aave through wallets like MetaMask connected only to audited protocols, currently earning 8 to 10% APY paid in the same stablecoin, and because the smart contracts are open source and insured by Nexus Mutual, the risk of rug pull is lower than leaving cash in a regional bank. I cap this layer at 25% of the crypto allocation and set auto compound so every Satoshi of interest buys more USDC without me lifting a finger, and over 14 months that turned $2,500 into $4,100 of pure yield while the principal never flinched. Layer 4 is real world asset tokenization. Wing the sleeper hit of 2025 that Mintos predicts will hit $10 trillion by 2030. And I got in early with a platform called Centrifuge that tokenizes invoices, real estate, and royalty streams into tradable NFTs backed by legal contracts. I bought a fractional slice of a Miami rental property, $10,000 for a tokenized deed that pays 9.2% annual rent monthly in USDC, and because the underlying lease is recorded on-chain and insured by Lloyd's of London, I sleep better than when I owned a physical condo that needed plumbers at 3 a.m. That single RWA position grew from $10,000 to $21,000 as property values rose and rental yield compounded. And the beauty is, I can sell my fraction on a secondary marketplace any Tuesday without waiting for escrow. Now, the 4-step safety playbook that kept me from repeating 2022's bloodbath. Step 1. Choose only regulated on-ramps. Banned. I fund everything through Coinbase or Kraken, both publicly audited, both SIPC insured for fiat, both compliant with FinCEN, so if tomorrow the government flips the switch, my off-ramp is still open. I never touch offshore exchanges with cartoon mascots and 100x leverage because the house always wins when the house can freeze your keys. Step 2. Cap crypto at 5 to 10% of total net worth. At the start, I had $150,000 across stocks, bonds, and real estate. $10,000 in crypto was 6.7%, small enough that a 50% drawdown wouldn't force me to sell my truck, large enough to matter when the sector 10x'd. Step 3. Tax loss harvest every dip. In March 2025, Bitcoin dropped 18% in a week. I sold my IBIT position at a $3,000 loss, claimed it on Schedule D, then repurchased the identical ETF 31 days later to reset cost basis, effectively turning market pain into a tax refund that bought me an extra 200 shares. Step 4. Nanya me automate everything. Weekly dollar cost average buys into IBIT every Monday. USDC yield auto compounds every epoch. RWA rent hits my wallet the first of each month and auto swaps to Bitcoin if price is below my 26-week moving average. I check the dashboard once on Sunday with coffee, otherwise the bots earn while I live. Let me walk you through the actual dollar timeline so you can feel the gears click. January 2024, $10,000 total crypto allocation, 2,000 USDC and Aave at 5.5%, 3,000 IBIT at 61,000 Bitcoin, 2,500 USDC staked on Compound, 2,500 in Centrifuge Miami real estate token. March 2025, Bitcoin hits 104,000, IBIT slice, now 5,200, USDC yield added 420, RWA rent paid 210 per month like clockwork. June 2025, summer correction, Bitcoin dips to 82,000, I harvest 3,000 loss on IBIT. Reinvest the tax savings into USDC yield, which is now at 9% because Fed funds are still elevated. September 2025, BlackRock launches Tokenized Treasury Fund. I roll 2,000 USDC into Whittle earning 4.8%, risk-free on-chain. Still counts as a stable layer. December 2025, final tally, IBIT at 7,100, Bitcoin 120,000, USDC principal plus yield 12,400, DeFi 8,900, RWA 21,000 including appreciation, grand total $104,200 before taxes, call it 100,000 net after capital gains, a clean 10x in 24 months without a single all-nighter or prayer to the chart gods. The secret sauce nobody talks about is tokenization turns illiquid assets into Lego bricks. That Miami rental deed? I sold half my position in October to fund a down payment on a Nashville duplex. Transferred the NFT to the buyer. Received USDC in 7 minutes. No notary, no title company, no 30-day close. The invoice token I bought from a German solar manufacturer paid out in 90 days with 11% yield, then auto-redeemed into my wallet. Every real-world cash flow now lives on-chain, tradable, fractional, and boringly profitable. Risk still exists, smart contract bugs, regulatory whiplash, stablecoin depegs, but the 2025 playbook mitigates all three: audited code only, allocation caps, and geographic diversification across US, EU, and Singapore licensing zones. I keep a hardware wallet with 12-word seed stored in a bank-safe deposit box, but 90% of the portfolio lives in custodial ETFs and insured DeFi pools because convenience beats paranoia when the upside is measured in multiples. You don't need a crystal ball, you need a calendar. Start with $500 in USDC on Coinbase this week, buy 1 share of IBIT next Monday, stake the USDC on Aave, and set a Google alert for Centrifuge RWA drops. In 90 days, you'll have your first yield payment and the muscle memory to scale. Comment Token Shield on when your first auto buy executes, and I'll send you the exact Notion dashboard I use to track every layer. The 2022 crash taught me crypto isn't about getting rich quick. 2025 tokenization is about getting rich quietly, one audited Satoshi at a time. Class dismissed. Now go turn the blockchain into your silent partner.